Let us see how do you do capital gains computation in case of non-residents. Now the concept is the same in the sense you take the sale consideration, right? Sale consideration minus cost of acquisition and you get the capital gain, right? But what we are talking here is a specific case. Let's see what specific case we are talking. We are speaking about a case where all non-residents are covered. So whether you are a company or you are a non-corporate assessee, okay, if you are a non-resident on the date of transfer, right? Please note, you have to be a non-resident on the date of transfer. So if you acquired the shares as a non-resident, but on the date of transfer you are a resident, then this section is not applicable. Okay? And you acquire the shares or debentures of an Indian company. Now this Indian company can be listed or it can be unlisted. Okay? So two conditions. One, you are a non-resident. Whether you are a company or a non-company doesn't make a difference on the date of transfer. Second, you purchase shares or debentures of an Indian company which can be listed or unlisted. Third, you purchased such shares or debentures in foreign currency. Now this is important. If you purchase shares or debentures in Indian currency, then this thing is not applicable. And this provision, if I were to just kind of write it down, is basically section 48. Okay. Let me just clear this. This is basically section 48, Proviso 1. Right. This is applicable when all these conditions are satisfied. That is, the buyer is a non-resident. Okay. Or actually the seller is a non-resident on the date of transfer. He purchases shares or debentures of an Indian company. So units of UTI or mutual funds etc. are not covered. Right. The Indian company can be listed or unlisted. The purchase has to be in foreign currency. Right. If you purchase it in Indian currency, this proviso is not applicable. And the last thing, no indexation is applicable even if long-term capital gains. This is contrary to what you understood earlier. So what we told you earlier was that in case of capital gains, right, the indexation is available if it's a long-term capital asset. But in case of a non-resident where the purchase of shares and debentures is done in foreign currency, no indexation is applicable. Right? So what is so special about this provision? The speciality of this provision is, if you see the first column, it's sale consideration less cost of acquisition, expenses on transfer, then capital gain. So there is nothing new about it, this portion, right? What is important is the right side of this, which is these two. Whenever you purchase the shares in foreign currency, the sale consideration which you have has to be converted into foreign currency initially utilized to purchase the shares. So let's say you have a non-resident who purchased 100 shares at $1 each. So his cost was how much? $100. Right? So when I write my sale consideration, it has to be $100. Right? And this conversion, okay, let's say you are told, okay, in the question you are told that instead of $100, you are told that the shares were purchased for 5,000 rupees on 1/1/2012. So what you will do is you will first count what is the average of the TT buying and TT selling rate on the date of sale. Okay, let me use a different stuff here. So let's say there is a sale of 100 shares for 50,000. Okay, this happens on 1/1/2012. The purchase was done, okay, let's say 1/1/2010, right? The expenses, let's say, were 10,000, right? The purchase cost, let's say, is 30,000. Okay, you have to calculate capital gains. So what you do is you start converting each of these items as per the details, which is what? For the sale consideration, you consider the average of the TT buying and TT selling rate on the date of sale. So let's say you sold it on 1/1/2012, you will see what is the TT buying and TT selling rate. These rates are basically the rates which are used by the SBI for the purchase and sale of foreign currency, right? So let's say the average of the TT buying, and these are basically given to you on the date of sale, is 30 or 50, right? So you divide this 50,000 by 50 and you will get 1,000. I'm talking about dollars here, right? And this currency conversion rate has to be applied for the currency which was initially utilized to purchase the share. So let's say if you purchase the share in US dollars, the TT buying and TT selling rate has to be for US dollar, right? Then the purchase price was, let's say, 30,000, right? So the purchase price is 30,000. So the cost of acquisition and the expenses on transfer have to be converted in foreign currency initially utilized to purchase, right? And how do you convert it? Average of the TT buying and TT selling rate on acquisition date for cost and on transfer date for expenses. So let's say, for example, on the date when you purchased, the TT buying and TT selling average was 30, right? So you will divide this 30,000, or let's not take 30. Okay, let's take 30 only, right? So 1,000 becomes your cost of acquisition. Are you noticing? If you would have taken this 50 as the rate, 30,000 divided by 50 will give you 600. Whereas now you are getting a cost of 1,000. The expenses have to be converted based on the TT buying and TT selling average on the date of sale, which is 50. So 10,000 divided by 50 gives you how much? $200, right? So 1,000 minus 1,200 gives you minus 1,200, right? I deliberately took a larger rate here, but if, let's say, for example, this was 40, you will get 1,250. 1,250 minus 1,200 will give you $50 of capital gain, right? Once you have these gain or loss, as the case may be, this has to be converted into Indian rupees, applying the TT buying rate on the rate of transfer. It's only the TT buying rate, right, and not the average, right? So let's say the TT buying rate was 54. So you will multiply this 50 by 54 and let's say you get 2,700. This is going to be your capital gain. Again, just at the cost of repetition, this is applicable only to non-residents. For shares or debentures of an Indian company, so units of UTI or mutual funds are not covered. These have to be purchased in foreign currency. Units of UTI and mutual fund excluded, right? Has to be in foreign currency, and there is no indexation when you purchase it in foreign currency. Please note that these provisions are mandatory. So if these conditions are satisfied, you have to calculate capital gain as per these provisions, right?